Title: Auto-Deleveraging America: Why the Next Crisis Starts in the Repo Markets. Chapter 1: The Calm Before the Unwind. The story starts in a moment that feels strangely calm. Markets are celebrating. Artificial intelligence announcements hit the tape every week with billion-dollar promises. Soft landing narratives dominate financial television. And at first glance, the data seems to agree. Gross domestic product running hot, unemployment still low, and the S&P touching new highs whenever a megacap whispers the phrase artificial intelligence acceleration. But beneath that surface, something else is happening. There are tremors you cannot see unless you know where to look. The kind of tremors that do not start with companies or households, but with funding, with the hidden machinery that keeps the entire system upright. A record surge in margin debt. Retail traders using leverage across 3 times and 5 times products. Private credit funds quietly waiving fees to avoid solvency breaches. Hedge funds running trillion-dollar basis trades on razor-thin liquidity. And repo rates, the interest rate on the safest collateral in the world, starting to drift above the Federal Reserve's comfort zone. Nothing big enough to cause panic, but everything big enough to be noticed by the people who watch the plumbing, not the headlines. This essay begins at the moment before the unwind, where the market feels strong precisely because the leverage beneath it is stretched to its limits. It begins in the same silence that has preceded every major dislocation of the last 40 years. The quiet interval before liquidity gets expensive, before collateral gets questioned, before lenders decide they would rather protect themselves than extend another dollar. And this time, the story does not start with banks failing, households defaulting, or companies missing earnings. This time, the story begins where the financial system sleeps at night. In the repo markets. Chapter 2: The Hidden Machinery: Understanding the Repo Engine. Most people think markets move because traders buy or sell stocks, but the real engine is not the trades. It is the funding behind the trades. Deep in the background of the financial system lies a market almost no ordinary investor has ever seen, yet everything depends on it. The repurchase market, or simply repo. Repo is the circulatory system of modern finance. It is where institutions go every night to borrow against their assets, using treasuries or mortgage-backed securities as collateral. It is where liquidity is exchanged, rolled, rebalanced, and priced, often in fractions of a basis point. In repo, the question is never, what do you want to buy? The question is always, what collateral do you have, and do we still trust it? A repo transaction is simple in theory. You hand over collateral, you receive cash. You agree to buy back that collateral at a slightly higher price. The spread is your cost of funding. But inside that simplicity is a system of extraordinary fragility. Repo assumes that collateral maintains value, that lenders accept it at stable haircuts, that markets remain liquid, and that trust remains unbroken. When any part of this equation changes, the entire structure becomes unstable. If repo is the bloodstream, collateral is the oxygen. If collateral gets questioned, if haircuts rise, if liquidity dries, or if lenders lose confidence, the system begins to suffocate. This is why the repo market is the sleeping giant of global finance. It does not react to headlines. It reacts to stress. It does not blow up on earnings misses. It blows up when funding withdrawals accelerate faster than borrowers can adjust. Every modern crisis, 1998, 2008, 2019, 2020, began not with a retail panic, but with a sudden recognition in the funding markets that collateral was no longer what it seemed. The next crisis will be no different. And auto-deleveraging begins the moment repo lenders decide the system is overextended and that protecting their balance sheets is more important than supporting anyone else's. This is the hidden machinery, a marketplace of overnight trust built on collateral that may or may not hold up under pressure. And right now, that pressure is rising. Chapter 3: Rising Pressure: Signals of a System Overextended. Pressure does not announce itself in a single headline. It shows up as fragments, scattered across markets, households, and balance sheets, until the pattern becomes impossible to ignore. And that pattern is now unmistakable. Margin debt has gone vertical. Retail investors have no buffer. Hedge funds are levered like never before. Private credit is starting to crack. Corporate borrowers are running out of time. When you line up all these signals, they tell a single story. The United States financial system is not just leveraged, it is overextended at every layer simultaneously. From households to hedge funds, from private credit desks to corporate treasurers, leverage is no longer a tool. It is a liability waiting for the first spark. And that spark always comes from the same place, the funding markets. Section 2, Chapter 4. The trigger point, stress emerging in repo markets. When a system is stretched, the first cracks do not appear where the public is looking. They appear deep inside the funding markets, the places only the largest institutions operate. And right now, that is exactly where the stress is showing. Repo rates are pushing above the Federal Reserve's target. In calm conditions, general collateral repo trades at or below the Federal Reserve's policy rate. It means liquidity is abundant, and lenders trust the collateral. But when repo rates rise above the Federal Reserve's target, it signals something else. Banks are hoarding cash. Lenders are demanding safer collateral. Borrowers are competing for limited liquidity. This is the functional equivalent of the first tremors before an earthquake. Lenders are quietly tightening terms. Haircuts are rising. Maturities are shortening. Certain mortgage-backed securities are being declined as acceptable collateral. These micro-adjustments reveal a macro truth. Funding desks are preparing for volatility. This is exactly what happens before auto-deleveraging begins. Large funds are avoiding the Federal Reserve's backstops. The standing repo facility was intended to act as a safety valve, but it carries stigma. Using it suggests weakness. Tapping it signals strained collateral. Visibility invites scrutiny. So even as repo markets tighten, large institutions avoid the facility, choosing balance sheet optics over immediate funding. The backstop exists, but no one wants to be seen touching it. The Federal Reserve has halted quantitative tightening early. Quantitative tightening was supposed to continue for months. Then, with little warning, the Federal Reserve announced that balance sheet reduction would stop on the 1st of December. The official line was administrative. The real interpretation was functional. Funding markets were tightening faster than policymakers were comfortable with. Month-end and quarter-end volatility is rising. These are the windows when banks must present clean balance sheets, when hedge funds must roll financing, when liquidity becomes strained. Every calendar turn amplifies the stress. Individually, none of these signals would constitute a crisis. Together, they point to a single conclusion. The funding markets are telling us that trust in collateral is weakening. And when trust weakens, lenders pull back. When lenders pull back, funding disappears. And when funding disappears, leverage gets unwound, quickly and without warning. This is the trigger point, the moment before auto-deleveraging begins in earnest. Chapter 5. Auto-deleveraging mechanics, how the system protects itself. Auto-deleveraging is not emotional. It is not personal. It is not even discretionary. It is mechanical. When collateral weakens and lenders sense rising risk, the system behaves the way it was built to behave. It protects the lender first, the borrower second, and the system third. This is the heart of auto-deleveraging, and it operates the same way in both digital asset markets and traditional finance. Auto-deleveraging begins when collateral cannot be trusted. The entire leverage structure rests on the assumption that collateral holds value, remains liquid, and can be sold quickly. When these assumptions weaken, the lender has one option: reduce exposure before losses materialize. The lender pulls funding preemptively. Auto-deleveraging does not wait for a full default. It triggers on probability, not certainty. The lender observes collateral slipping, borrower fragility, market volatility, and liquidity thinning. Then the lender acts before the borrower collapses. Borrowing lines get canceled. Haircuts rise. Terms tighten. Margin calls appear in accounts that seemed safe. Funds waive fees rather than liquidate. The system is protecting itself. Forced liquidation is not optional. It is a safety protocol. When auto-deleveraging begins, assets are sold, collateral is seized, funding is withdrawn, and leverage is reduced. The weakest fall first. Retail investors face margin calls. Households lose vehicles to repossession. Delinquent borrowers face foreclosure. Corporate credit begins to fracture. Private credit structures fail compliance tests. Hedge funds unwind crowded trades. Banks raise haircuts and decline collateral. The system knows where the weakest collateral lives. And that is where auto-deleveraging begins. According to subject matter experts with direct knowledge of the repo and credit markets, Forced deleveraging is not catastrophic by design. It is the stabilizing function of the system during periods of overextension. It is the system saying, I will not let your problem become my problem. The mechanics are ancient. Only the collateral changes. Chapter 6. The domino structure, where the cascade flows next. Once auto-deleveraging begins, it does not move randomly. It follows a predictable path, a chain reaction that cascades upward through the system. The sequence is now forming beneath the surface. Households are the first domino. Auto loan delinquencies rise. Repossessions accelerate. Subprime credit cards roll deeper into delinquency. Certain mortgage vintages begin missing payments. Foreclosures appear at the periphery. The earliest signal of auto-deleveraging is the liquidation of the weakest collateral. According to subject matter experts with direct knowledge of the repo and credit markets, a substantial foreclosure wave is likely by the second quarter of 2026. The bottom layer is already cracking. Corporate borrowers are next. The refinancing wall of 2026 will force companies that borrowed at 3% to refinance at 8 to 11%. Many cannot absorb the jump. Some cannot refinance at all. This is where bankruptcies begin showing up in headlines. Private credit is the blind spot. It is now larger than the subprime market was in 2006, but with less transparency. CLO structures are failing solvency tests. Managers waive fees to avoid breaches. Different firms hold the same loan at drastically different marks. This is the shadow leverage that experts warn is 2 to 3 times larger than the structures that broke in 2008. Hedge funds are above this layer. They are running more than $2 trillion of leveraged treasury basis trades. These rely on stable repo funding. When repo tightens, these trades become vulnerable. A forced unwind here can destabilize the treasury market itself. Dealers and primary banks are the final line of defense. If dealers withdraw, repo collateral gets refused, haircuts rise, liquidity evaporates, and forced sales accelerate. This is what happened when Chase declined to roll Lehman Brothers collateral. A single refusal detonated the system. The cascade moves upward. It always has. From retail to households to corporates to credit funds to hedge funds to dealers to the core of the funding system. Once the cascade reaches funding, it becomes systemic. Section 3, Chapter 7. The recognition phase, when the narrative breaks. A system can absorb stress quietly for a long time. It can hide fractures behind liquidity, policy, and momentum. It can even maintain the illusion of stability while leverage unwinds at the edges. But every deleveraging cycle reaches a point where the narrative breaks. And when it breaks suddenly. This is the recognition phase, the psychological moment when both markets and the public realize the downturn is already underway. The data turns before the narrative does. The first signs are already here. Continuing jobless claims rising toward 2 million, benefit exhaustion rates approaching 40%, federal severance packages expiring for tens of thousands of workers, private payroll revisions quietly converting positive months into negative prints, delinquencies rising even while the official unemployment rate remains low. The economy weakens before the story does. The soft landing illusion begins to fracture. For months, markets embraced a comforting narrative, inflation cooling, rates about to fall, consumers robust, artificial intelligence creating endless growth, no recession in sight. But auto-deleveraging behaves differently. Households conserve cash, delinquent borrowers fall off benefit programs. Corporates slow hiring, bond markets widen credit spreads, liquidity becomes selective rather than abundant. At some point, the soft landing narrative can no longer reconcile with observable reality. When that point arrives, sentiment flips fast. Fear migrates from risk assets to credit markets. Recognition does not start with stocks. It begins in credit. The moment investors begin hedging with credit default swaps or demanding higher junk spreads or refusing private credit marks or withdrawing from new issuance or selling even high-grade bonds at the margins, it means confidence in collateral has weakened. When credit stops believing, equities follow, not the other way around. The media narrative lags by weeks or months. Headlines arrive late. At first, they ask whether volatility is temporary. Then they speculate about slowdowns. Eventually, reluctantly, they acknowledge widening cracks. By the time mainstream coverage catches up, the system is already deep into the deleveraging cycle. Recognition unfolds in layers. Households notice first through job loss and delinquency. Corporations notice next through refinancing stress. Credit markets notice when spreads blow out. Equity markets notice last, but react the fastest. According to subject matter experts with direct knowledge of the repo and credit markets, this is the moment to watch. When unemployment rises despite strong headline payroll prints, when credit tightens even while equities remain buoyant, when funding markets grow selective, when the narrative diverges from collateral reality. This is where liquidity disappears the fastest. This is where auto-deleveraging accelerates. Recognition is not the cause of the crisis. Recognition is the moment the crisis becomes visible. It is the moment the story catches up to the math. Chapter 8. The Federal Reserve Dilemma. Policy at the Edge. The Federal Reserve is often portrayed as the omnipotent actor in financial dramas, the institution that can cut, print, ease, or intervene its way out of danger. But in a deleveraging cycle driven by collateral deterioration and funding stress, the Federal Reserve's power is both immense and limited. Because when the repo markets begin to tighten, the Federal Reserve faces a dilemma with no clean exit. Quantitative tightening was supposed to continue, until it suddenly could not. The Federal Reserve abruptly announced that balance sheet reduction would end on the 1st of December. The official reasoning was technical. The real reasoning was functional. Funding markets were tightening more sharply than expected. The plumbing was becoming brittle. Rate cuts are theoretical. Funding stress is real. Commentators debate forecasts for rate cuts. But repo markets do not care about forecasts. They care about liquidity. Repo stress can occur while inflation is low, unemployment stable, gross domestic product positive, and equities rallying. It is indifferent to soft landing narratives. The Federal Reserve can cut rates, but cuts cannot guarantee funding flows in a system where collateral trust is weakening. The backstop exists, but no one wants to touch it. The standing repo facility is designed as a safety valve, but it carries stigma. Tapping it implies weakness. Drawing from it reveals strain. Institutions avoid it to protect appearances. A safety valve cannot function when the system refuses to use it. Political timing makes the dilemma worse. 2026 is a year of leadership uncertainty and fiscal pressure. Any incoming chair faces a no-win configuration. Ease too soon, and inflation resurfaces. Ease too late, and the funding crisis deepens. Remain neutral, and the refinancing wall detonates corporate credit. This is not a tightening cycle or a loosening cycle. It is a containment cycle. Liquidity injections are not the same as liquidity demand. The Federal Reserve can supply liquidity, but it cannot force lenders to accept collateral. It cannot force borrowers to roll debt. It cannot fix solvency with liquidity. It cannot restore trust in shadow credit. It cannot override auto-deleveraging when risk models demand it. The toolkit was built for demand crises, not collateral crises. In 2008, collateral was toxic. In 2020, collateral was healthy, but the economy stopped. In 2025 and 2026, collateral itself is weakening again. When collateral weakens, the lender withdraws. Haircuts rise. Liquidity thins. Margin calls appear. Forced liquidations cascade. The Federal Reserve can slow the cascade. It cannot stop the cascade. The Federal Reserve does not determine leverage cycles. Leverage cycles determine the Federal Reserve. Policy is downstream from the funding markets. Chapter 9. The Unseen Consequence. Auto-Deleveraging as a National Event. Every deleveraging cycle begins in the markets, but once it gains momentum, it spills far beyond Wall Street. Auto-deleveraging becomes a national event. When forced sales begin, investors do not sell what is failing. They sell what is liquid. Bitcoin, because it trades constantly. Gold, because it is globally liquid. Large cap stocks, treasuries. Corporate credit sold only when necessary. The healthiest assets fall first. Not because fundamentals changed, but because they can be converted to cash quickly. Passive investing adds violence to deleveraging. Most retirement savings are in automated funds. These rebalance mechanically. They sell bonds when stocks fall. They buy stocks when bonds fall. During auto-deleveraging, this does not soften volatility. It amplifies it. Markets collapse before the economy collapses. Liquidity evaporates before fundamentals weaken. Funding disappears before job losses appear. This is why deleveraging feels sudden. Shadow credit riptides become visible. Private credit structures cannot hide stress indefinitely. Fee waivers break, solvency tests fail, fund marks diverge, losses migrate to pensions, insurers, and endowments. This is when deleveraging becomes societal. The labor market reacts slowly but painfully. Unemployment rises last, but rises quickly when it begins. Hiring freezes expand. Temporary jobs vanish. Corporate layoffs follow refinancing stress. Public sentiment snaps. Narratives collapse. The public asks what changed. The answer is simple. Auto-deleveraging became visible. According to subject matter experts with direct knowledge of the repo and credit markets, auto-deleveraging is not just a market event. It is a national event. The entire country reprices risk simultaneously. Households delever, corporates delever, governments delever, pensions delever, lenders delever, investors delever. These cycles define generations. They reset wealth, valuations, policy, and expectations. America is approaching that threshold. Chapter 10. The shape of what comes after. Every deleveraging cycle feels like catastrophe as it unfolds. But when the forced liquidations end and weak collateral has been purged, a new landscape emerges. The first thing that stabilizes is collateral. Haircuts stop rising, repo spreads normalize, high-quality assets regain consistent bids, dealers return to making markets, credit default swap spreads settle, liquidity flows resume. Stability begins with trust in collateral, not with price. Funding markets heal before the economy does. Job losses continue. Bankruptcies continue, but repo stabilizes first. The plumbing reopens. Recovery begins invisibly. Policy arrives late with a new mandate, not to inflate assets, but to stabilize credit channels, cushion labor markets, and prevent cascading defaults. This is not 2020. This is targeted stabilization after the system has purged its excess. Asset markets enter a new regime, lower leverage, higher risk premiums, more durable growth, less speculative excess, stronger demand for safe collateral. Safe haven assets find their true bid once forced liquidations cease. Gold stabilizes, Bitcoin rebounds sharply, treasuries reprice. Real assets outperform synthetic ones. Households and corporates reset their baselines. Less borrowing, more discipline, better underwriting, more cautious risk appetite. A new narrative emerges, slower, more grounded, more real. Stability is understood not as the product of leverage, but as the result of resilience. And the final realization: the crisis never starts where people expect. It does not begin with consumers, corporates, banks, or markets. It begins in the funding markets, when the people who lend the overnight dollars decide the collateral is no longer good enough. The next crisis will begin where the modern financial system sleeps every night. In the repo markets, where auto-deleveraging quietly starts the next reset.